If you own a rental property or you're thinking about buying one, there's one topic that makes a huge difference in how profitable that investment actually is, and that's taxes. Not the exciting part, but absolutely one of the most important. Because two people can own the exact same rental property, make the exact same rents, have the exact same expenses, and end up with very different results, simply because they understand the tax side differently. In this video, I'm going to give you a clear, practical overview of how rental property taxes actually work. And if you watch this all the way through, you'll walk away knowing how rental income is really taxed each year, what depreciation actually does, and what it doesn't do, and what to consider when you sell that property. No jargon, no accounting background required, just clear, simple information you can use for every rental you ever own. Let's dive in. Let's start with how rental income is taxed. The main benefit of owning a rental property, you guys, is that it appreciates over time and produces income. And when it comes to that income, the IRS expects you to pay tax on it. But rental property acts like a business, and businesses have expenses. The good news is that you are not taxed on the total rent you collect, you are taxed on your net rental income, which is a simple formula: rent collected minus deductible expenses. Let's talk about common deductible rental expenses. Now, some of the most common deductible rental expenses include advertising to find tenants, auto and travel expenses for driving to and from that property, cleaning and routine maintenance, commissions paid to property management agents, HOA fees, insurance, mortgage interest, legal and professional fees, property management fees, mortgage points, property taxes, and the utilities you pay for the property. We have a lot of expenses here that can be deducted. Now, a side note, when people are analyzing their first deal, they almost always underestimate expenses and they overestimate their profits. Now, that's one of the main things we help people avoid inside our program. And if you want help running the numbers on your first deal before you buy it, check the link in the description. We'd be more than happy to talk. Now back to it. One very important distinction is the difference between repairs and improvements. Repairs are things that simply fix or maintain the property in its normal working condition. Examples include fixing a leaky faucet, repairing a broken door, replacing a damaged window, or patching and repainting walls. These costs are generally deductible in full in the year you pay them. Now, improvements, on the other hand, are things that add value to the property, extend its life, or significantly upgrade it. Examples include remodeling a kitchen, adding a new bathroom, replacing the entire roof, or building a deck. Now, these are not immediately deductible. Instead, they get added to the basis of the property. So what is basis? Your basis, you guys, is essentially how much you have invested in the property for tax purposes. Let's say you buy a rental property for $420,000 and you also pay $12,000 in closing costs for legal fees, title fees, recording fees. Your starting basis is $432,000. And let's say a few years later you spend $18,000 remodeling a bathroom. You guys, that's an improvement. That's not a repair. So it doesn't get deducted right away. Instead, we add it to your starting basis, so your new basis becomes $450,000. After you know your basis, we can talk about depreciation. Depreciation is one of the most misunderstood parts of rental property taxation. The IRS assumes that buildings wear and tear over time. For residential rental property, the IRS assigns a useful life of 27 and a half years. But please note that land does not depreciate, it's just land that will always be there. So when you buy a property, you're really buying two things: the land and the building. And only the building portion can be depreciated, as that's what's wearing and tearing out. Continuing our example, suppose the county assessor says that out of your $450,000 total basis, $130,000 is the value of the land and $320,000 is the value of the building. That means $320,000 is depreciable. And if you divide $320,000 by 27 and a half years, you get an annual depreciation deduction of about $11,635 per year. This is a non-cash expense. You don't actually pay this amount each year, but you still get to deduct it from your rental income. Crazy, right? So what does this look like on your tax return? Well, most rental properties are reported on Schedule E of your tax return. And on this form, you list the property address, the type of the property, how many days it was rented, how much rent you collected, and all of your expenses. Let's say the property rents for $3,300 per month, which means you collect $39,600 for the year. Now, suppose your expenses look like this: insurance, taxes, management, maintenance, and interest total $21,500. And your depreciation, again, is $11,635. Your total expenses are $33,135. So even though you collected $39,600 in rent, you guys, your taxable rental income is only $6,465. And remember, over $11,000 of that deduction came from depreciation, which did not actually cost you any cash that year. Even if the property was vacant for part of the year, as long as it was available for rent and ready to be rented, you can still deduct the expenses and the depreciation. In this example, we had a net gain, but what if we had a net loss after the expenses and depreciation? Well, whether you can deduct that loss against your other income depends on your total income and your situation. We'll discuss deducting losses in future videos. Now let's fast forward and say you sell the property after owning it for 8 years. Assume you sell it for $540,000, and over those 8 years you took about $11,635 per year of depreciation, for a total of roughly $93,080. Your original basis was $450,000. After subtracting that depreciation, your adjusted basis is now about $356,920. Please note that when calculating your adjusted basis, you always take your original basis minus depreciation. Let's assume you also pay $32,000 in real estate commissions and selling costs. So your taxable gain ends up being approximately $540,000 minus $356,920 minus $32,000, which equals $151,080. Now, here's the part that surprises a lot of people, you guys. The IRS treats the portion of your gain that came from the depreciation differently. That part is taxed at a special rate up to 25%. This is what we call depreciation recapture. Only the remaining portion of the gain is taxed at the lower and more beneficial long-term capital gains rates. This is why depreciation is not free money. It's better thought of as a tax deferral. Here's how the $151,080 gain is actually taxed. Step 1, you identify the depreciation portion. You deducted $93,080 of depreciation. That means $93,080 of your gain is depreciation recapture. And this portion is taxed at up to 25%, not at the capital gains rates. Now, step 2, let's calculate the rest of the true capital gain. Your total gain was $151,080. We minus the depreciation portion of $93,080, which means your remaining capital gain is $58,000. Now that $58,000 is taxed at the long-term capital gains rates, which are a combination of 0%, 15%, or 20%, depending on your income. So you might be wondering, what if I just don't take depreciation? You guys, the IRS is clever, and they don't let you avoid this. They use something called allowed or allowable depreciation when you sell. So even if you don't take the deduction, the IRS acts like you did and still makes you recapture it when you sell. Now, I bet you're surprised, right? The IRS. So in almost all cases, you guys, you should take the depreciation each year. Now, is there a way to avoid taxes when you sell the rental property? The answer is yes. The tax code allows something called a Section 1031 exchange. This lets you sell a rental property and reinvest the money into another rental property without paying the tax right now. Instead, that tax is deferred. That includes the capital gains tax and the depreciation recapture tax. Using our same example, you sell your rental property for $540,000 and your taxable gain is $151,080. Now, normally you'd owe tax on the $93,080 at up to 25%. That's the depreciation recapture tax, and tax on the remaining $58,000 at the more beneficial long-term capital gains tax rates. But instead, you do a Section 1031 exchange and you roll the money into a new property worth, say, $750,000. The result is that you pay $0 in tax today and simply carry your old tax basis forward into the new property. So you've delayed the capital gains tax, depreciation recapture tax, and kept your money working for you. The catch is that you didn't eliminate the tax, you guys, you just postponed it. If you keep exchanging properties over time, you can actually defer taxes for decades and potentially eliminate them at death through what we call a step up in basis under current law. But that's a whole different topic. So overall, here's the big picture. 1, rentals are very tax efficient while you own them. 2, selling them does create a big tax event. 3, depreciation, you guys, is a deferral, not a gift. And 4, Section 1031 exchanges are how investors really keep scaling without losing capital to taxes. Team, the goal of this video wasn't to turn you into a tax expert. It was to give you a clear mental framework for how rental property taxes actually work. while you own your property, and when you eventually sell it. Now, if you're thinking about buying your first investment property, this kind of understanding is what helps you move forward with confidence instead of guesswork. And if you want help building a real plan and avoiding the most common beginner mistakes, you can book a free discovery call for our program using the link in the description. And one quick reminder before we go, this is general educational information, not personal tax, legal, or investment advice. Be sure to always talk to your own tax advisor before making any decisions. So thanks for watching, you guys. I hope you learned a lot. I'll see you in the next one.